first, Mike, I'm going to give you the first comment here. In the end, we did have 4 sectors closing lower, albeit industrials and materials just by about a hair. Financials closing down 1.5%, and real estate leading by more than 1%. So a play there on rates.
Definitely, and a little bit of defense. I mean, this was a day where it was, for the average stock, a very normal bout of modest profit taking after a really good run. That was masked because Apple was up 3%. Amazon was up 2%, and if you look at their contribution to the S&P, Apple, Amazon, Microsoft, Facebook, Tesla, basically were your whole story. That doesn't mean it was, it's not valid. The points count. It's just more about the character of what's been going on today, and the market playing defense as a way of essentially holding the highs that were achieved into the end of last week.
Catherine, do you think these buoyant levels on the stock market are justified, or are you more concerned than you are optimistic?
Oh, I am very concerned. I've been concerned for a long time. I've been wrong. The market just keeps going higher and higher. And ultimately, I think it's all about the Fed. I think if you look at what's going on, the Fed is our best friend. And the Fed, the Bank of Japan, the European Central Bank, their goal is to keep indebted companies with very low interest, negative interest, and there's a lot of money flowing into the markets. It's indiscriminate, and I think it's going to go on. It makes it hard for a stock picker to really distinguish oneself.
Jason, as we look at things more broadly, and now that we have Jackson Hole in the rearview mirror, what do you think is going to be the major catalyst for the rest of 2021?
Yeah. So for me, I think it's going to continue to be earnings growth. This year has been about earnings growth. Last year was a different story. But for me, I think that's where we move forward. I think Catherine makes a great point just on liquidity and where we are with rates, and it makes it difficult to figure out when this pullback will happen. I mean, we haven't seen one in 10 months, but I think it's going to be about earnings growth. I think it's going to be established companies that have great balance sheets that will carry us further from here.
Mike, clearly that spike in yields, spike's perhaps too pronounced a word, but that pickup in yields last week is already in the rearview mirror. And does that mean that from here on out for the rest of the year, we're looking at yields having peaked?
I wouldn't say that I would be willing to really, stake too much on a claim like that, but it's definitely been a struggle for the Treasury yields to maintain, any kind of upward path. In fact, the last, just on a month-to-date basis, we had a peak around 140, and then it couldn't stay in the 130. So it has rolled a fair bit. I think 1.2 sort of separates the kind of levels of near the lows versus holding above the lows. So we'll see if we have to challenge that. But it shows you a lot of things. One, clearly the Fed not really going to move very fast on anything. We have naturally slowdown fears out there. We have the global search for all the factors that we know about, but also the inflation panic has essentially cooled off, and so I think the market's essentially buying, Powell's line that says, one, we do believe that inflation will recede from these high levels, and two, when we eventually begin to reduce the bond purchases by the Fed, it's not going to lead very quickly to higher yield. So you're getting, in fact, things like the 5-year note going down in yield because they're taking expected rate hikes out of the market to some degree in the last several days.